Hey, good morning, everyone. Welcome to the macro snapshot for Tuesday, February the 17th, 2026. We're recording this in the morning just before 7 o'clock. Okay, let's have a quick look and see what's going on. Obviously, we had the markets more or less closed yesterday. The cash markets were closed yesterday. There's not a huge amount of data just today. In the next couple of days, we have in Canada the inflation numbers. In the US, we have the Empire survey, which will give us a little bit of information. We also have the ADP in employment numbers. So let's have a look at 8:15 and see if the ADP numbers confirm that strong non-farm payrolls we had last Wednesday. So that's something interesting to keep an eye on. Apart from that, we have a couple of speakers from the Fed. We have Barr and Daly around about lunchtime, just after lunchtime. Not sure how market moving that'll be. And then possibly what's most interesting is going to be the Reserve Bank of New Zealand this evening and the press conference. I'll get onto that in a little bit. But I think really what the market wants to be looking at is probably the equities. But before we look at the equities, let's just look and see what's happening at the VIX. Still quite elevated. So the point is that when you have a VIX up at almost 22, that is relatively elevated, quite elevated, and therefore we can expect a little bit more sort of volatility. If you look at also at the futures, they're also at 21, 22, and I think I showed it on the video on Sunday that if you look at the term structure, we're actually slightly in a sort of a backwardated state. So the point is that the equities will probably need the VIX to go down a little bit, the volatility curve to go back more into a contango shape, just to have more of a sort of a tailwind for the equity. So keep an eye for those of you trading throughout the day just on the VIX and the VIX futures. They do need to not only come down in absolute terms, but also that term structure. That curve needs to come down at the front end just to signal that the market is relaxing a little bit more. If we look at other things, if we look at the VXX ETF, again, you can see that that's a little bit elevated as well. Almost like, excuse me, almost like a bit of a triple top. I'm not saying it's a classical triple top, which will break towards the upside, but I just want to signal that the volatility space overall for the equities is elevated. So we can expect some movement today. If we look at also in the bond market, look at the move index. So you remember, people who watch this video, that for a long time that seemed to be in quite a big sort of downtrend, the volatility of bonds. But what we've seen over the last 4, 5, 6 days there, you can see it's starting to trend upwards. You see the 20-day EMA here is starting to trend upwards. And history tells us that what the equity market hates more than an elevated VIX is elevated bond volatility. The equity market historically, if the economy is strong and earnings are strong, the equity market, it can live with relatively elevated yields, but it does not like those yields changing quickly. So the fact that the move index here is showing a bit of volatility in the overall sort of bond market. Again, that's a slight sort of headwind, I would say, for the equity market. Now, again, I'm not saying because this chart has gone up a few points, therefore equity is going to collapse today, but we are seeing volatility going up in not only in the VIX but in the bond market, and that is not a positive for the equity market. Just while we're on sort of volatility here, you can see that the oil vol is actually coming down, so that's a positive. If we look over at the precious metals, you can see that the volatility has come off its extremes. Here's gold volatility, but still a little bit more than historically it's been. So calming down, but not all clear. And we look at silver, similar kind of situation, that obviously silver volatility has come down, but still quite very elevated compared to historical levels. So that's just something to keep an eye on. Okay, if we actually look at the equities themselves, excuse me, let's just have a look at the indices. And the reality here is that, think about what's going on here. We're getting to a situation where we're getting relatively positive news, and the equity market is not reacting in a very positive way. Obviously, there are sort of pockets of strength and pockets of weakness. But for the indices, we had a very strong non-farm payrolls. Last week, we had the unemployment rate going down. We also had a very, relatively benign inflation print, which I'll show you some numbers. Actually, let's have a quick look at some of those inflation breakdowns. Now, of course, on Friday we get the core PCE. Now, we haven't had an update in the core PCE since November because of the shutdowns in the government. So this core PCE on Friday is important to see whether it actually confirms what we seem to be seeing in the CPI. So if we just have a quick deep dive here. in the inflation numbers. You can see here, this is broken down into the key elements: food, energy, core goods, and then core services. And what we can see is that overall, obviously going back to the bad old days of 2022, 2023, when we're up at almost 9%, you can see that overall, the trend is has been down, and it's flattening. And what's going to be encouraging, I think, for the Fed is that core services, which has been the biggest component and very sticky, kind of in this sort of terracotta orange color here. You can see that that had been trending up, but it now does seem to be trending down. Now, of course, one or two readings is not necessarily the totality of the information we need, but the reality is that core services does seems to be pushing down. And you can see that other things like core goods, food and energy, you can see that they seem to be quite contained. So overall, a fairly positive breakdown. If we just look at a couple more charts, you can see core PCE also, has been not quite as low as the core CPI. So that's why maybe the market needs to sort of see that confirmation or not this Friday morning of the core PCE here in the blue. And if that continues to come down and sort of echoes what's been happening in the CPI, maybe that could be a positive for the stock market, the equity market. But again, as you can see here, we're still quite a long way from the Fed's 2% target. But is that acceptable? I mean, it's under 3. We have a Trump administration which is seemingly wanting to run it hot, and of course we've had the tariffs, which haven't turned out to be as inflationary as some economists had called for. Talking about the tariffs, there is a chance that this Friday we get the Supreme Court decision on the legality or not of the of Trump's tariffs. A lot of the prediction markets and a lot of commentators are saying that it quite possibly will be ruled illegal. But Trump has already said that they're going to go and sort of slap on some temporary measures. There's like a possibility of a 150-day tariff, et cetera, et cetera. So I'll talk about that later in the week. But just keep in mind that we could get an update there. But just continuing here with the inflation, you can see also if we look under the at some different ways of looking at inflation, you can see that the trimmed mean, which is kind of like a sort of a core inflation number in the orange here, that seems to be pointing downwards. If you look at it from the median, that seems to be pointing down. Even the super core, which is Jerome Powell's favorite one, so that's basically services excluding housing. The super core here, that seems to be pretty good. And the sticky price, this is from the Atlanta Fed. So this is basically prices which logistically take a long time to sort of change because they're quite sort of structural. Even the sticky price CPI is going down. So overall, it looks as though inflation is moderating. The problem is, from a political point of view, is that prices are still elevated. So we had maybe inflation, so the increases are diminishing, so less increases, but that doesn't mean that prices are now not at a permanent higher level than they were, let's say, 2 or 3 years ago. And that's still why people are feeling pessimistic, and consumer confidence readings are down. If we also look at 1-year inflation swaps, which is in the black here, this is the market-based measures of where they think inflation will be in a year. You can see that, at the beginning of the year, that had sort of crept up a little bit, but is now sort of trending down a little bit as well, as is the 10-year Treasury yield. So overall, the point I'm trying to make here is that with pretty good news on inflation and a relatively solid, quite a solid labor market. Just to go back to the equities, it's like, why are the equities not sort of ripping higher here? And we also know, I was just reading this morning that sort of earnings actually are pretty good. EPS estimates are pretty good. So I guess we have to put this down just to concerns about the capital expenditure, these massive amounts of money which the hyperscalers, the big sort of 6 or 7 tech companies are spending. I'm not obviously the first to say that. And also concerns that AI is going to be incredibly disruptive. We saw last night there was a video going viral about sort of robots doing some kung fu dancing over in China. It's the Chinese New Year, a huge celebration there. And some people saying maybe it was a bit of a fake manipulation of the images. But the point is that robotics is advancing very, very quickly, especially in China. And there is a fear that a lot of companies, especially those companies which only deal in software purely, are going to be sort of wiped out of existence, or at least their multiples should be marked down. Anyway, so just getting back to the technicals here. So we see on the indices trading heavy, the SP 500 futures, the ES, of course, are down at the 100-day moving average. And again, you could see overnight on the shortened day yesterday, and overnight price action remains very, very heavy. Um, so where could this get down to? Obviously, we're looking, I mean, you got levels all the way down here at about 6,600. You've got the 200-day moving averages, the both the simple and the exponential, which are further below. And then you've got a local low at 67.47. So the point is here is that even now the short-term moving averages, and those of you who've been watching this video for, I don't know, the last few months or years, I mean, look at this. Look at these sort of short-term, the 20 and the 50 moving average up, 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 up. But for the very first time, we're actually in danger of seeing the 20 cross over the 50 EMA. Now, we haven't seen that for, as my father used to say, in donkey's years for a long, long, long time. We haven't seen this for a long, long, long time. And so you can start to see here that the shape of the moving averages is turning over. And that also is significant because, things like the CTA, the trend following funds, the vol targeting funds, we see volatility a little elevated, as I mentioned earlier, but especially things like a lot of funds are trend following, and they will mechanically and automatically, as the momentum starts to stall out here, and the moving averages starts to cross over, they will slowly but surely start reducing their position size. They may not go short yet, but they will start reducing their position sizes mechanically. And of course, that could start then to lead to some cascading effects. So we're at definitely a delicate moment here. So let's watch the price action this morning. And as I say, keep an eye on the volatility, and you have the technical levels there. If we also look at the Nasdaq, you can see that's trading even more heavily. In this case, the 20-day moving average has already crossed over, like 10 days ago or so, over the 50. But now we're getting the danger, like the 50 is now trending down towards the 100, and we can see now that we're also in danger of retesting the 200-day EMA. So the Nasdaq generally much weaker than the ES. And again, you've got some very key support here. You could obviously see this horizontal support, which coincides with the recent low, which coincides more or less with the 200-day moving average. So absolutely critical areas around about, let's call it, 24,000 and a quarter, 24,000 and a half, 24,500. If that, we might expect some kind of reactive bounce there, but if that can't hold, you're starting to look at a little bit of downside pressure. But there are still several areas here where it still could hold, around about the 24,200 level, the 200-day EMA. So I'm not going to say that this breaks just at this point, but things are definitely starting to roll over. We look at the Russell. Now, the Russell, of course, has been a pocket of relative strength, not outright strength, because it's failed to achieve its recent highs. You can see here. So let's keep in mind this is relative strength, not outright strength. Yeah, so just while we're looking at that, it's probably a good moment to look. What I'm looking at, and I recommend, is looking at all of these key subcomponents just to sort of see who the winners and losers are. We see here that the equal weight, again, has been a pocket of relative strength. You see the moving averages for the equal weight, the RSP, that's still doing quite well. We had a big down day on Thursday, but some kind of recovery there. Really, excuse me, what we're going to have to see is the Mag 7. So the big tech names in general are going to have to start performing if the indices are going to reclaim highs. I don't know, maybe we need a technical washout. Maybe the market's concerned about the Supreme Court case, maybe volatility. But as I say, this is not a healthy market at the moment because we're starting to get bad price action on relatively good news. When you get good news and weak price action, that is generally not a good sign. And as we can see here for the MAGS ETF for the large cap tech companies here, you can see that we're already touching the 200-day EMA. The moving averages are rolling over, and generally this price action is starting to look distributive and weak. You see lower highs, failure to make recent highs. Again, though, there is some support. If we were to break that, you do have support down at $58. That's possibly even a nice entry point. But overall, if the mags continue to be heavy as we're seeing and rolling over, it's going to be very difficult for the indices themselves to roll up in any shape or form. Now, where we are getting some strength is at the semiconductors. Although having said that, they did fail here. They did fail to make a new high. You see here at 420, they actually failed. Elon Musk will like that number 420. But you see at the top here, they failed to make a new high here. And there's a bit of an indecision day on Friday. So it's going to be quite critical because if we start to, we know that the Mag 7s are weak. And we also know, of course, the pure software companies here, like you see here, there was a very pathetic failed rally here. trying to bounce here. But again, this is like forming, testing a recent low here, double bottom. It's going to be interesting because if this shows no strength, this could be sort of a failed sort of bounce, a dead cat bounce, and we could start to get sort of floodgates opening towards the downside. There is support here for the IGV, the software sort of ETF here. So I'm not saying it's going to break, but it looks as though it wants to retest that. So it's a pretty critical few days coming up. I would say because we're seeing that the SMH, so the semiconductors failed to make a new high. We see that the software ETFs kind of failed a bounce here, and we also see that the Mag 7. So nowhere in the tech space are we seeing sort of strong price action. We are seeing strong price action in things like the energy stocks and various other sort of parts of the market, but just in the tech space, which has been the general, as people say, like the leaders, the generals, they're starting to roll over. So look at all of these today, and if we look at the breadth as well, this is the percentage of stocks above the 50-day moving average. You can also see that that's starting to trade heavy as well. So equities under pressure, at least in the US space. If we look at global equity, if we look at the SPY versus Europe and the Far East, like in terms of developed markets here, you can see that in the US also underperforming. If we look over at Europe, just over the last couple of days, you can see that the Euro Stock 600 actually still trading, relatively well. It's certainly like the equivalent of the US would be down here or something, but you can see over in Europe, the Euro Stock 600 trading pretty well. If we look at, let's say, the Nikkei in Japan, a little bit of weakness, but overall trading well. If we look at Brazil, I like to look at a bit of weakness, but trading well. It's always the same thing. So, these global equity markets will come down if the US comes down, but overall the relative strength is in overseas markets or non-US markets. And if we look at something like the Kospi, which is the semiconductors over in Korea, and the memory makers, memory card makers and whatnot, doing very, very well. So the Kospi remains pretty strong. And if we look at emerging markets, you can also see that that has retained its strength. So definitely we're seeing strength in emerging markets. So the countries to look at, countries like Poland, for example, I was doing some research over the long weekend, very, very strong over in Poland. Brazil, we're seeing a commodity story. There's pockets of strength. Korea obviously is doing very well. So that's maybe something to be looking at as some of those ETFs for the various countries in emerging markets excluding China EMFX. For example, if we look at FXI, the Chinese large caps, that actually has been relatively weak price action compared to sort of other markets. So something like China, a little bit more trading like the US, but Europe and emerging markets and sort of certain pockets like Korea and Poland is actually trading much better. So I think really it's and energy has been trading well. So in terms of the equities, it seems to be a moment of picking winners and winning sectors rather than losers. Maybe even doing some long short kind of spread trades on those kind of things. Okay. So just getting on to some other things, which is interesting. Just looking at the bonds here, looking at the US bonds, what I would say, actually, I'm going to look at the just quickly at the yields. Look at the 2-year yield here. The 2-year yields come down a lot, and we know that about two cuts have been priced in by the Fed. But you can see it's sort of getting down to a level at 3.38. Now we've got a Fed funds rate of about 3.64, 3.63, and to be honest, I think it's going to be difficult here. You've got the 2-year trading, about 20, what's that, 40, about 22, 23 basis points. So almost a full cut below the Fed funds rate. And I think we're getting to sort of a limit here of how low the 2-year yield can go, unless we start getting, like, let's say the core PCE comes in like super low again on Friday, and the data starts to roll over. So the employment situation starts to deteriorate, and everything else starts to deteriorate. We did see a weakish retail sales, and we do get some GDP information. So I just think at the moment, the 2 years got to be pretty much anchored and a bit stuck here. I don't know how much more that can go. But what we're seeing here is that, is interesting that the long end of the curve, so the 10s and the 30s are getting to a point where they're really accelerating towards the downside. So low yields. And that's what I'm trying to say. It's interesting that equities can't get more of a bounce because you have very, very low yields. Yields which are diminishing, shall we say, or reducing. So this is a positive environment for the equities. What is interesting though, just in terms of that, is that just how low can these go? And I'm just thinking it's starting to get interesting to me, looking at a potential short here for some of these long-term bonds. And so if we actually just go back to the um, let's say something like the ZN, you've got to say that, once you get up to about 113.23, and obviously the perfect price, something like 113, 114 up here would be a very attractive like sort of entry point for a short. I mean, it could squeeze up a little bit more, but I think, start nibbling once it gets up to, let's say, 113.23, and certainly something like 114 on the ZN could be a pretty good risk reward. And I think on something like the ZB at 119 could be a pretty good level. I think it's going to be difficult. My point is that, there's been a large rally here, maybe a bit of a short squeeze, a large rally in the long-term bonds. And I think that, let's say, for example, the GDP comes in reasonable on Friday. Also, core PCE maybe is not as cool. If that has crept up during over the course of the week, I think that could be an interesting level here to be shorting some of those longer term bonds. Definitely something I'll be keeping an eye on. The other thing, well, just reading about the dollar, fairly quiet in the currencies. Dollar finding a little bit of strength. I was saying on Sunday in the big video that there was a bit of sideways consolidation. Dollar positioning is the most bearish it's been. I was reading some research the last couple of days for the last 14 years. If you actually look at surveys of trading desks and futures positioning, dollar shorts are the most short they've been for 14 years. So that's a perfect recipe, of course, for a kind of a short squeeze. And maybe we want to start getting that in the absence of clearly bearish data, the absence of clearly bearish data for the US economy. And we know that inflation is going down. It's kind of priced in a little bit. Could we just see the US dollars drifting higher here again? And again, it has to get, the key level is going to be this 50% fib level at about 97.5 and sort of 98. That's going to be key. So it's going to be something interesting to look at here. Other thing I want to look at today, we have the Reserve Bank of New Zealand. And you can see that the New Zealand dollar is starting to pop. Looks as though this could be some kind of bull flag. Now, this is pretty interesting here because the Reserve Bank of New Zealand, keep in mind, this is going to be the first meeting for the ex-Swedish bank the person. The new governor is Anna Brennan, and she's been employed by the basically by the government of New Zealand. She's now the governor, but she's actually was at the Riksbank, so the Swedish central bank. It's going to be her first meeting, so that's kind of interesting. And what's basically been happening, New Zealanders are not expected to do anything at this meeting, but basically they're expected to hold. But it could be a relatively hawkish hold, just because the projections for inflation, the inflation rate has actually come in a lot stronger than the RBNZ's own sort of projections. So you can see here that the actual inflation rate, you can see how it's actually is been going up and up and up, and the projections have had it going down. So there's been a bit of a divergence, which is a bit embarrassing for the economists at the RBNZ. So the point is that maybe this is the meeting with, as I say, new governor Anna Brennan coming in to say, whoa, because we're going to have new projections for the inflation, but also the GDP and the economy this evening. I think what time is it? At 7:30 or no, 8 o'clock, and then the press conference at 9 p.m. So if those projections for both for CPI and also the economy come in a little hotter, a little stronger than expected, we can see some repricing here potentially for the overnight cash rate in New Zealand, and that could be basically fairly hawkish. Now we get a couple more meetings. We get meetings today, obviously, and then on April the 8th. We don't actually get another sort of quarterly CPI reading until April the 20th. So it's going to be a bit tricky because there won't actually be that much CPI data for another sort of period of time and another couple of meetings for the Reserve Bank of New Zealand. So the point is that the projections, what I'm trying to say, simple English in a roundabout way, excuse me, I've been a bit prolix, is that the projections, if they are revised upwards for CPI and for the general economy, could be a boost for the New Zealand dollars. And you see here that the official cash rate, you see they cut fairly aggressively. You see they cut a lot, but the market pricing is starting to go up a little bit, and the projections maybe even going to be revised upwards. So keep an eye for those of you trading that. If they're revised upwards, we could see strength in the New Zealand dollar, maybe even strength and the New Zealand dollar over the Aussie. We'll look at the chart in a second. And in terms of current pricing, the current pricing, which I last checked, was for 40 basis points. So between 1 and 2 hikes in 2026. And for the September meeting, there's the first one of 18 basis points. So that pricing could go up from 18 basis points in the September 26 meeting, and maybe by the totality of year end for 2026, it could go from 40 basis points, maybe even up to 45 or 50. So there is potential there for some sort of hawkish repricing. And what's interesting, as I said, is that potentially we're looking at hikes in Reserve Bank of New Zealand. And of course, we had the hike by the Reserve Bank of Australia last week. So we're starting to get this sort of divergence. You've got the BOE in the UK sort of potentially cutting. You've got the Fed obviously potentially cutting 2 or 3 times this year. The ECB is sort of in the middle. We don't exactly know what's going on. So we're starting to get divergences here. And this is hopefully could shake up the FX market. And if we're just getting back to the New Zealand, sorry, where are I? My bad, as people like to say. So yeah, so again, New Zealand dollar here, just sort of zooming out a little bit against the US dollar. Obviously, this is going to depend a lot on the US dollar, of course, is the big brother in this partnership. But for sure, we could maybe, get up to here 60.9, maybe even up here 61 and a quarter, something like that. There is a little bit more upside. And eventually over time, if the data in the US starts to weaken and maybe the Fed cuts more aggressively than expected, and maybe if inflation in the US continues to trend downwards as we've been seeing, who knows, maybe the New Zealand dollar does have the potential to push up towards 62 over time. And then if you against, for example, the Australian dollar, which is an interesting one, which I do like to trade myself. Do I have it up here? Yeah. So just to have a look on the chart here, you can see that the Aussie has been very, very, very strong versus the Kiwi over, well, basically going back sort of 8, 9, 10 months or so. But could this be just a moment for the Aussie to a lot of the hawkishness? Can you argue that some of the strength and the hawkishness has been priced in? It's gone up quite a lot. I mean, it's still a very bullish chart. There's nothing technically telling you to short here, but I don't know, maybe there could be something to be done there. Let's keep an eye on that at some point if, maybe it starts to sort of show some sort of fading. Okay, in terms of other stuff, I want to have a quick look at energy. Pretty important sort of talks going on between the Iranians and the Americans in Geneva over the next few days. You can see here that oil's had a little bit of a boost, but still essentially trading in this range here between 65.5 and let's call it $62.5. And this is going to really depend on the talks, because we know the fundamentals are relatively mixed. And not necessarily bullish, not necessarily bearish. It's a fairly mixed picture. The Iranian president was out with some fairly aggressive comments. And we'll see what happens. I don't want to go too much into it because I've already spoken a little bit too long here. But basically, I think there's still a chance of military action, to be absolutely honest. The Americans are building up a large sort of military force there. There's been some aggressive rhetoric by various members of the American delegations. On the other hand, Trump occasionally says, hey, I think they want to do a deal. What is interesting is that the Iranian delegation is very tech heavy. I mean, how can I say that? It's full of technical specialists about. So the Iranians are clearly trying to position these talks as we want the sanctions lifted. We're happy to talk about the uranium enrichment program. The Iranians are less happy to talk about giving up their military capabilities, weakening their ballistic missile program, funding sort of proxy sort of military sort of arms, in sort of Lebanon and Gaza and Yemen and whatnot. So there seems to be a different pathways here. And I think the possibility is for a breakdown in talks. I think it's still possible. And so therefore the oil market is signaling some concern as well. And as long as there's geopolitical risk, the oil market, I think, does have the potential to grind higher. And obviously, if we do see an outbreak of hostilities, that could, explode higher. And we did see yesterday that the Iranian sort of Navy was conducting live fire exercises in the very critical Strait of Hormuz, where about 20% of the world's oil transits every day. So, the oil market is still very much on edge. Just finally, guys, I don't want to go too much. Let's have a quick look at the metals, and we have Chinese Lunar New Year. The Chinese market is on hold. is on a break for a week or so. I think it's still consolidating. I think gold, can it go up more? That's my belief is that the macro factors are still there, and you still see these moving averages still pushing a lot higher. Having said that, with the Chinese market away, there's going to be less sort of marginal buyers there, less sort of energy, and again, I just sort of I think sideways consolidation, similar kind of thing in silvers. Actually, let's look at the spot price here. See, silver actually has had fairly weak price action. You see these bounces here have not come through. There's been lower highs. So this is weak price action. We're starting to see a bit of weakness here. And I think silver definitely could just sort of fade down towards, let's say, the $70 level, 70.5. Could buyers come in at that point? Yes. But at the moment, I think we're just still waiting for the volatility to come down. It could be that this grinds downwards towards, 70.8 just over the Chinese New Year. And who knows, maybe when the Chinese Asian markets come back online, there could be some dip buys coming in. That could be an interesting price level. Finally, just want to close out, have a quick look at our old friend BTC. Again, not doing anything horrible in the last few days, but no energy in this price. It's still distributive. It's still, I mean, you can see here consolidating in the sideways range. So probably not much to do there. At all. Okay, guys, I'm going to leave it there. I think that's all I wanted to say. As I say, we've got ADP coming up in an hour or so. And we have the Reserve Bank of New Zealand, which is expected to be a relatively hawkish hold this evening. That'll be something to be looking out for. And of course, let's keep an eye on all of the equity, not only the indices, but personally, I'll be looking at all of these sort of subcomponents to get a better view of what's going on. And I'll be keeping a very sharp eye on the VIX and volatility. Okay, have a great trading day, and I'll be back tomorrow with the macro shop from with the macro snapshot from the macro shop. Thanks very much. Have a great day.